Let's look at an example of how stock prices can fluctuate. Say you bought 100 shares of Super Stereo at $10 per share 1 year ago. Imagine the economy is thriving, companies are expanding, business is booming, stock prices are rising, people are happy. After a year, Super Stereo shares are valued at $20. Because it experienced a very profitable year, Super Stereo decides to pay dividends to its shareholders. Dividends are a share of the profits. Companies can award dividends in the form of additional shares, cash, or both. Let's say Super Stereo pays out a dividend of 40 cents per share. Wow, that's 40 bucks in your pocket. Plus, you've doubled the money you invested in the stock. With this kind of return, it would be silly not to invest in the stock market, right? Not necessarily. Have you ever heard the saying, what goes up must come down? Well, it's a common occurrence in the stock market. Remember those Super Stereo shares worth $20 each? Let's see how they're holding up. It's 2 months later, and you're at the breakfast table checking out the value of your stock in the morning paper. While you weren't paying attention, the value of your stock fell to $15 per share. Oh no! How could that happen? If you act fast, you can still hold on to some profit. You call your broker and tell him to sell, sell, sell! Only other investors have caught sight of the declining prices, and they decided to let the share price bottom out before they purchase. By the time your broker finds a buyer, the share price has declined to $5. That's $5 less than you paid for them. You've just lost half of your investment. Well, if there's one thing you can count on in the stock market, it's volatility. Whoa! Volatile means unstable. Volatility accurately describes the daily fluctuations in stock prices and the unpredictable nature of the economy. Investing in the stock market is risky. That's the trade-off for the potentially excellent returns. Economic conditions can change quickly. Investors really have to stay on top of the game in order to be successful. So, if the market is so risky, why do people take the chance? People who can afford to take a chance invest in the stock market for higher returns, sometimes as much as 40% annually. They win some and they lose some, but for the most part, they stay ahead. For those of us who can't afford the high risk, financial institutions offer more stable investments such as savings accounts and certificates of deposit. Although they only pay an average of 3 to 7% annually, the money is very secure because the government insures them. So, the key to making money in the stock market is the same as buying a good apple at the grocery store. You have to know how to pick them. That means you have to do your homework. Successful investors research company financial statements, they interpret economic trends, and they measure the potential growth of companies to determine whether or not they are sound investment opportunities. Some investors pay financial analysts to research the market and monitor their investments. Either way, investors have to go through a broker to purchase and sell shares on the stock exchange. Brokers are licensed to trade stocks.